Alright, in this video we'll see how to calculate the risk and return of a portfolio that consists of 2 stocks or 3 stocks using Microsoft Excel. Alright, before we start, let's see what we are dealing with and what we are trying to do here. Suppose we have 2 stocks, stock X and stock Y, and we also know the past returns of these 2 stocks, annual returns for last 5 years. And we want to create a portfolio using these 2 stocks where we invest 30% of our money into stock X and the rest 70% into stock Y. Now, the way we will be solving this problem is applicable when we have a few stocks in a portfolio. Suppose we have 2 stocks or 3 stocks in a portfolio, then we use this approach. But whenever we have many stocks, like 10, 20 or 100 stocks or bonds or a combination of stocks and bonds, then we are better off using a little bit more complicated process that involves using and creating covariance matrix. And you may also want to look into some risk and return trade-offs using efficient frontier. Now, we are not going to cover all those things in this video, but if you're interested, I will be linking to really good videos on this topic. These are made by a finance professor called Colby Wright, and I hope those will be helpful. But if you are only interested in portfolios that involves 2 or 3 stocks, then this video will do just fine. Alright, the first thing we need to do is to calculate the average for these 2 stocks for the last 5 years. Now to do that, we'll be using Excel's built-in average function. This is the function, and the input will be the actual returns for these 2 stocks. So for stock X, the returns are this. So select this, close the bracket and press enter. And let's do the same thing for stock Y. So for stock Y, the average return was 9.4%. Now to calculate the standard deviation of stock X, we will use stdv.s function. This function returns the standard deviation based on a sample data. So the inputs will be the same, the returns of last 5 years. So close the brackets and press enter. This is the standard deviation for the returns of stock X, and for Y it is this much. Now let's copy some values from these cells to here. Yeah, and then have a look at the formula for expected return of a portfolio with 2 assets. As you can see, this is actually nothing but the weighted average of these 2 stocks. So let's do it in this cell. What we do, we multiply the weight of stock X with the return of stock X. Then with that we add the product of stock Y's weight and its return and press enter, and we get 9.7% as the expected return. Now calculating the expected return was really that simple, but when we want to know the risk or the standard deviation of the portfolio, we need to know a few more things, like what is the covariance or correlation between these 2 stocks. Now to calculate the covariance, we'll be using Excel's this function, covariance.s. This function takes 2 arrays. The first array is basically the stocks returns for stock X, and the second array is the returns for stock Y. Alright, so press the equal sign and type this function, and from the drop down menu select this one, and the first array is from here to here, then press comma, then give it the second array, then close the brackets and press enter. Alright, so the covariance is 0.00233. Now to calculate the correlation, use this function, and the inputs are same as before. So this is the first array and this is the second array. Close the brackets and press enter. Alright, now using this covariance, we will be calculating the standard deviation or the risk of this two asset portfolio. We'll do this in this cell. Press the equal sign and select the square root function. And then in the square root, we'll put everything that's in between these two parentheses. So the first thing is the weight of stock X. With that, multiply the standard deviation of stock X. Then add the product of weight of stock Y and standard deviation of stock Y. Then add 2 multiplied by the weights, and with that multiply the covariance, which is this cell. Then close the brackets and press enter. So this is our standard deviation for this two asset portfolio. Let's format this cell. I'm sure you can do the same thing for a 3 asset portfolio. You just do some slight modifications here and here and easily figure out what are the risks and returns. So that's the end of this video. If this video is helpful, please consider leaving us a like or comment or subscribe, or I don't know, whatever helps. So see you in the next one.